Welcome back to Am I Catching a Falling Knife? The podcast where we cut through the market noise to help you understand if a recent stock dip is a golden opportunity or a dangerous trap. I'm your host, Dave, and today we're putting cybersecurity giant Fortinet, ticker FTNT, under the microscope. This stock has taken a significant tumble, dropping over 28% in just the last few days. So, is FTNT a bargain in the making, or is there more pain to come? Let's find out. All right, so what's really behind Fortinet's sharp drop? The dominant market narrative points squarely to investor uncertainty about the sustainability of its growth. Even though Fortinet reported strong Q2 2025 earnings, the street is worried about a few things: slowing service revenue, the potential for their shiny new SASE solutions to cannibalize their bread-and-butter core firewall business, and, naturally, some analyst downgrades piling on due to valuation concerns and competitive heat. Let's take a quick look at the company itself. Fortinet, FTNT, is a global leader in cybersecurity, offering everything from its famous FortiGate firewalls to endpoint protection and secure access service edge, or SASE. Their whole ecosystem, the Fortinet Security Fabric, wraps it all together. They make a good chunk of their revenue, over 60% in fact, from recurring subscription services, with the rest coming from product sales. Geographically, they're pretty balanced, with about 41% from the Americas, 40% from EMEA, and 19% from Asia-Pacific. Financially, they're pulling in over $6.3 billion in annual revenue, with a solid $1.88 billion in free cash flow and a healthy gross margin of over 81%. They also keep their debt relatively low, under $1 billion. Now, let's break down how this market narrative could impact the numbers. Our analysis suggests this investor uncertainty could translate to an estimated 10.1% negative impact on their quarterly earnings. So, how did we get there? Let's walk through the steps. First, the narrative highlights slowing service revenue. Since service revenue makes up about 68% of Fortinet's total revenue, we've estimated that if this segment underperforms expected growth by 5%, that alone translates to a roughly 3.4% negative impact on the company's overall top line. Next, there's the concern about SASE cannibalization impacting their core firewall business, which falls under product revenue, about 32% of total revenue. If this shift causes a 2% underperformance from expected product revenue contribution, that's another 0.64% negative impact on total revenue. When you combine these two effects, we're looking at a total estimated revenue shortfall of about 4%. Here's where Fortinet's high gross margin of over 81% comes into play. Because their operating expenses are relatively fixed in the short term, a revenue shortfall has a magnified impact on net earnings. We've applied an earnings leverage factor of about 2.5 times, which is typical for a high-margin tech company like Fortinet. So, that 4% revenue shortfall, multiplied by our leverage factor, gets us to our estimated 10.1% hit on quarterly earnings. Now, to figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. First, a discounted cash flow, or DCF model. For this, I'm making a few key assumptions: a growth rate of about 9.7% for the next 5 years, a discount rate of 9.5%, and a terminal growth rate of 2.5%. Based on these assumptions, our base case DCF value for FTNT comes in at around $49.67. However, when we adjust this for the narrative's impact, that estimated 10.1% earnings hit we just talked about, our DCF value drops to a narrative-adjusted $43.21. The second method I'm using is a bit simpler, a PE-based valuation, which stands for price earnings to growth. This metric helps us assess if a stock's price is reasonable relative to its earnings growth. Using this approach, the fair value for Fortinet comes in significantly lower, at about $36.45. So, if we compare today's price, hovering around $75.30, to these calculated valuations, you can see why the market is reacting with such force. It appears the stock is trading at a significant premium to what our models suggest is its intrinsic value, even after this recent slide. Given these valuations, and if you're thinking about potentially catching this falling knife, my custom buy levels are set quite a bit lower: $55, $45, and $40. These are the price points where the risk-reward starts to look more compelling, aligning more closely with our valuation models. So, to wrap things up on Fortinet, FTNT, remember, what we've discussed today is for informational and educational purposes only. This is not financial advice, and you should always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thanks for tuning in to Am I Catching a Falling Knife? I'm Dave, and I'll catch you next time.